We are now less than 3 hours away from Ben Bernanke's speech. Other central bankers from around the world are concerned because any mention of quantitative easing, a round of QE3, could potentially rattle other economies. Tim Bitsberger works with BNP Paribas as a consultant to central banks. He's also been an assistant Treasury secretary. He's in Washington, joining us from there this morning. Tim, glad to have you back on the Inside Track. How panicked are some of the clients that you're talking to right now?
I don't think they're panicked at all. I think they're looking at this the same way that all investors are. I think that they have, obviously there's a lot of anxiety about today's speech, but I wouldn't sense any panic at all.
So, but the idea is, or one of the things that you have to be discussing the most is currency appreciation.
Correct. And I would think from the policymakers at other central banks, one of the things that they probably would not want to see would be another round of quantitative easing, because that would just continue to put upward pressure on their currencies.
Let me ask you then, we saw an op-ed by Paul Krugman in the New York Times today saying he thinks we should actively pursue well, I think debase is not the word he wanted to use, but we should actually pursue a weakening of the U.S. Currency. We should actively pursue inflation targets of 3 to 4% going out to force savers to take their cash off the sidelines. I mean, what do you think about that kind of policy suggestion?
I think that sounds a little dangerous to me. I think there'd be a lot of unintended consequences with debasing the currency. I think you want a stable dollar, you want stable currency markets. To throw that type of uncertainty into the marketplace, I think could scare off investors and particularly bondholders.
Is there something then that the Fed could do to encourage growth? Because that's what Krugman was trying to get at. He was saying, look, we have no growth. We're in a period of stagnation. A lot of people have said we're sort of turning Japanese. Is there something the Fed could do to encourage growth, or do the tools that Ben Bernanke has at his hands not really work that way?
Well, I think what we need to see is just, better harmony between what they're doing on the fiscal side and what they're doing on the monetary side. For example, it's one thing for the Fed to, successfully lower interest rates, but it's another thing if people can't refinance their homes. So, lower yields, across the yield curve is one thing, but unless people can act on that, it's not going to make much of a difference.
Tim, that brings up a point that Phil Swagel told Matt and I earlier, this idea that it's Congress that has to act at this point, not the Fed. Do you agree with that?
Well, I think Phil brings up an excellent point there, but I'll just say they need to work in harmony. And to the degree that I do think the Fed has shot a lot of its bullets. I think the announcement recently about keeping the funds rate at 0% for a couple of years, that had a significant move on the entire yield curve. So I think the Fed has shot a lot of its bullets. I don't expect certainly a QE3 announcement today, but I think it's up for Congress and Treasury and the White House to look to get the fiscal side in order, because I think Phil brings up a great point.
Well, the point is, I think, taken from or made also by the White House, because the New York Times yesterday saying that Washington, the White House, thinking about a plan where as people could refinance mortgages at 4% or at similar rates, and that would be backed by Fannie and Freddie. What do you think about that plan? I mean, surely everybody who hasn't got a mortgage at an interest rate that low would want in on it.
Well, I mean, I think any type of housing reform or mortgage finance reform, they're going to be losers, and it's just a question of how you divide up that part of the pie. The taxpayer is going to have to share some of the burden, banks are going to have to share some of the burden, and bondholders are going to have to share some of that burden. So it's just a question of how you divide up that pie. But that is just a huge overhang on the market, and the Fed's done its job lowering interest rates. Now you need to let homeowners take advantage of that.
Tim, just out of curiosity, when you use the term the Fed has shot its bullets, does that mean because you feel like they're no longer effective in the marketplace, or because there's no other tool that you think the Fed should use?
Well, I think the Fed's been very effective. They have a yield, Treasury bills are yielding 0%. 10-year notes are in the low twos. They've been very effective at lowering interest rates. Now it's just a question of just spurring investment and making it the right atmosphere for investors and for capital to be deployed. And I think that's where I think a lot of the uncertainty and the overhang is coming from Congress and the White House. I think you need to get those ducks lined up first.
Tim, thanks as always. Tim Bitsberger joining us there from our D.C. bureau. He is the managing director at BNP Paribas.